Hello, everybody. It's Jake Senziano, host Jake and Gino Podcast, here with my co-host, the multifamily mentor, the coach of chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Jake, I'm doing good. Obviously, you're doing better than me because you've had your espresso this morning. I haven't had my espresso yet, so hopefully I'll have one waiting when I finish the podcast, Jake.
You know, I think you got bigger problems if you don't, and I'll help you work through that, Gino. I know you're a coach and everything, but sometimes you need to,
I need to be coached. You're right. That's right. You're right. I'm slipping. I get it.
And the call is going to be about, taking the power back in the home. All right. But we don't need to do that now. We got a good guest today. Today's guest is a physician and co-founder of Passive Advantage, a platform dedicated to helping busy professionals build wealth through passive real estate investing. He also co-developed the LP Deal Analyzer, a widely respected tool designed to help investors assess risk and returns with clarity. And I think 2 clicks in less than 30 seconds. So we're going to like that. Okay. You can take that one to the bank. So without further ado, Sam Giordano, welcome to the show.
Thanks for having me, guys. I just want to thank you for all the education and knowledge you provided. Back in 2017, I started listening to podcasts, and yours was one of the first ones I started listening to, and have been sort of a loyal listener since then. So I really appreciate
just
you having
sort
me
of.
on.
just a little bit. Like you're okay at first, but then I had to switch over to Joe Rogan. All right, fine, fair enough. So I looking at your bio and stuff this morning. So was there a transition from your medical background into commercial real estate, and if so, I'd just love to hear sort of how that developed.
Yeah, no, I appreciate it. So yeah, just to give a little background, I'm a practicing physician, so I still am practicing. Thankfully, over the last...
What's the specialty?
Gastroenterology. So
okay.
I call myself a belly doctor. My kids call me a butt doctor. So, but I do colonoscopies, do endoscopies, stuff like that. So I've been practicing.
So do the lentils actually, cause the leaky gut? And is the term leaky gut just like a professional way to say you're farting? Like I'm trying to understand some of this stuff now because my wife's going down this path.
I've got 14 years of medical training, and I'm trying to understand the leaky gut business myself. So I don't know that I can.
No, because I'm hearing these guys talking about it. I'm like, leaky gut. Am I just supposed to know this term? And so I'm looking into it. And I think because I'm gonna keep this short because we're going down a rabbit trail. But like there's like this like siete lentil that's like with spicy, and she's like, I don't know, it's causing the leaky. I'm like, what the fuck's the leaky gut? So I had to look this up, and it just sounds like you're farting. But am I incorrect in stating this, or
I think the flatulence is part of the whole
He's
process.
so professional, Gino. We can say farting on this show, right? I think it's fine.
There you go. I'm trying to keep it clean, but you know what I mean? No, it's a complicated topic, that leaky gut business. Yeah.
Is it more complicated than real estate?
That's what it sounds probably is, actually.
So, okay, last question on this. Do you keep the lentils to a minimum here? And Gino's going to take this question in a second.
I love lentils. I like them any shape I can. I like the black ones. I like the brown ones. My wife makes lentil soup.
He likes lentils like he likes his women, Gino. All right, that's what he's saying.
Well, one last question. Is it more difficult to define what a cap rate is, or is the leaky gut more complicated, Jake? That question's for you.
Every time. Leaky gut every time.
All right. So GI doctor, back to your story. We'll try to keep this professional from here on out. Appreciate
There you go. So yeah, I've been practicing for like 13 years since I finished training back in 2012. And
okay, last question. What part of the country?
In New Jersey.
Got it. Okay.
In New Jersey. Yep. Yeah. I grew up in New Jersey, born and bred. My wife is a California girl. We met in training in Philly. So somehow I convinced her to stay in Jersey, although I kind of fight.
She loved the weather
every day. She's like, especially during the winter, she's like, what are we doing in Jersey? Why don't we go? I'm like, I can't live in California. I'm a Jersey guy. But anyway, so yeah. So when we're taught when we first get out of training to kind of get all the personal finance ducks in a row. Jim Dolly of White Coat Investor is him and I are friends, and he's been a mentor in terms of getting the personal finance stuff. And it's not that complicated. Maxing out your pre-tax accounts, doing backdoor Roth IRAs, kids 529s. Then eventually you pay off the loans, you pay off the car, and then you sort of do some taxable brokerage investing. So now in a physician's life, if you're doing it right, you should be somewhere like 5 to 7 years out of training where you get to that point. And that was for me back in like 2007.
I'm sorry, what point?
The point where you've got all those processes set up. It's all on autopilot. You're doing the pre-tax stuff. You're doing the kids 529s. You're not thinking you're not doing anything active anymore. It's just getting that sort of implementation plan in place. So I work.
It seems like a long time to get there. No,
5 to 7. Well, you hear like
because you're getting your debt. I got it. You're getting your debt paid down. Is that the idea? Okay.
You're getting your debt paid down, and then you're getting like the automated processes for doing all those other things.
You're like mid-30s by that point, then, yeah.
You're in your 30s before you finish training. If you do what I do, it's I didn't get done till like
it's a long dedicated road, my friend.
It's a hike. I love what I do, but it is a hike. So you get to that point, and I teach personal finance. We have like 700 physicians at the hospital I work at. So I teach them personal finance, getting to this stage. But once you get to that 5 to 7 years out and you do that stuff, then you're like, all right, well, what's next?
I want some more.
Exactly. So at that point is around when living in Jersey, where the Tax Cuts and Jobs Act was enacted, and we got hit with losing the SALT deduction, which was a big deal in some of these high tax states. And I was like, what the heck is this tax bill? Like, what do I got to do to kind of improve that? So I was looking into real estate. I was looking actively initially, like quadplex, short-term rentals, and turnkey properties. And then I came on real estate syndications, and it sent me down like a rabbit hole where I was absorbing that's around the time I started listening to you guys. I was reading every book, listening to podcasts, active on real estate forums. And it kind of opened up this whole new world for me. And that's sort of when I started my syndication investing at that point in time.
Let me ask you, Sam, right now, if you're thinking about all the processes and what you're talking about is really building the foundation. And listen, I have a book that I'm going to send to you after the podcast is over. It's called Happy Money, Happy Family, Happy Legacy. Just launched it. It's perfect and ideal for what doctors really need, because they're in a grind, and a lot of the information is, some doctors may not want to do the 401k, the 529, but they still need to build that foundation. What would you say to those doctors? Because there may be some doctors out there that are like, I'm making enough money, I'm just barely making ends meet. Like, where do they start? I mean, I don't think they should start investing in commercial real estate right out of college. That may not be the first step, but where should they start? If I'm out there and I'm trying to build a financial future or trying to create wealth.
Yeah, no, that's a great question, Gino, and I really appreciate you offering to send the book over. I'd love to read it, but yeah. So, and this is where the sort of mantra, like live like a resident, where if you
hold on, a resident of a multifamily community, or are we talking a medical resident?
We're talking the medical resident community.
Okay, just want to clarify, because our listeners are kind of in this. You know what I'm saying?
That's a good point. I'm glad. I appreciate the clarification. So yeah, just to give you some perspective, as a resident, you may make 40, 50, 60 grand. So, you're not rich, but you're making a living. So, and then you transition to an attending, which is like a full-fledged physician job, where you may be making 3, 4, 5, depending on your specialty, 100 grand. So that transition is the point you do this, Gino, because if you wait till 3, 4 years out, you start getting the BMW, you start getting, and then you have no
shackles.
Chance. Yeah, exactly. So as soon as it starts, you keep that resident salary ish. If it's working with your income, 80, 90 grand, even though you're making 300, and then you plug it into all these other areas. So you don't even notice it, because you're just making what you made the last year. And then once you get these things paid off, you start to loosen the purse string. So for me, you have to start before you get to taste that income. Otherwise, it's going to be an uphill battle.
Sam, I'll take it one step further. In the book, I talk about a person's relationship with money. Why is it that you need to buy a BMW when you're 300 grand in the hole? Is it your relationship with money is poor, or that's how you feel significance? I'm not judging, I'm not criticizing, but there is a true way to wealth. And Jake and I talk about baby money soldiers. And really what doctors are trying to do is they're trying to accumulate as many baby money soldiers and not kill them by going out and buying a BMW, because once they're dead, they can't procreate. And understanding basic financial intelligence is so important for a community that is vastly superiorly intelligent to Jake and Gino when it comes to finance.
How about that? You guys know Leaky Gut better than I do.
I think that's just our wives.
At some point. But okay, so let's transition back into this. You're in the real estate thing. Why LPs? How did you come up with this platform or this software? What made you want to go down that hole and start helping others with LP investing?
Yeah, no, I appreciate the question. So, when I started to learn about syndications, like a lot of docs, and it's not a negative connotation, but a lot of us are detail oriented, maybe a component of OCD to where
we hope you are. Okay. We really hope you are, because the opposite. Yeah.
You don't want to be like, you take this medicine, whatever. but so when I was doing that education for a year, I told myself I'm going to spend an entire year to just educate myself, because these private placements, 25, 50 grand minimums, like that's nothing to sneeze at. Like when you look at the amount of income.
But on the flip side, you're also on the low end for the investing piece of it, right? You're kind of like, that's like the entry level. So it's a lot of money for the investor, but the guy raising it, you're sort of like getting in at the bare minimum too.
Yeah.
So it's
you're totally right. You're absolutely right. And so when you look at that much money, I wanted to be sure I knew what I was getting into. So I spent an entire year to educate myself. And in doing that, I sort of made an Excel sheet for myself to give myself a little bit of security to say,
smart.
When I get this private placement, like, what's the entry cap? What's the exit cap? What's the rent growth? What's the sponsor experience? Full cycle deals.
You systematized your LP investor experience.
That's correct. Yeah. And it was really just for me. Like I was just like, this is what I'm going to do so I don't make any stupid mistakes and forget something that I'm supposed to be looking at.
Because here's the thing. I just want to say this because you're an LP, you do a couple, but you have these rules in the beginning that you're worried about. Then you get loosey-goosey. Then the market heats up. Then you get a little competitive. And then somebody's bringing you a floating rate deal. And all of a sudden, shit explodes. But if you have rules that you live by from the beginning and you don't start to bend as the market accelerates or decelerates, whatever, you're insulating yourself. And we can expand upon that. But I just want to highlight the importance of that, because that's where folks are going to get burned in commercial real estate. If you have good rules to live by, and you know what you're talking about in the beginning, don't bend in the future because the market changes. Be patient and pass on the deal. But
you're 100% right. No, you and I are on the same page with that. So that was my philosophy. And then I'm pretty active in these real estate forums in terms, whether it be Bigger Pockets or other private real estate forums. And one sort of forum post that we were going back and forth, I mentioned this Excel sheet. And the next day I got like 150 private messages, like clouding my inbox, asking me if they could have access to this LP Excel sheet that I was using. And then I'm like, you know what? I have no problem sharing it. Like I'm happy to do that. But at the same time,
it seemed basic to you, right? Like the thought process was basic. You just didn't want to have to keep thinking every time you did one of these. Yeah,
exactly. But I didn't want to take on the sort of responsibility of telling someone else that this is some of the risk points for me. So at that point, I felt like, both in terms of me being at a hospital with 700 physicians that are getting into these syndications, asking me questions all the time, if I could come up with a website where I could point to people in a central direction, have this, and that was the inception of passiveadvantage.com, where basically limited partner investors go to this website. It had, articles and stuff like that to help educate.
That's just an education site. I'm not familiar with it. I'm sorry.
At that time it's just an education site, and I linked other people's articles. It wasn't even all original content. But then we also had this Excel sheet that we professionalized to where limited partners could use this sheet for themselves. And so that was a couple years back to where we grew to like 1,500 investors, and then next thing you know, investors want to since they did have to still manually go through the deal and plug it into the Excel sheet. Now it obviously highlights risk points to them because it color codes red, yellow, green based on the deal metrics and the risk associated. It's really not to tell people invest or not invest. It's just that these are some of the risk points. You can still choose to invest, or you go back to the sponsor and say, why are you projecting an 8% rent growth? Or where, if there's any like areas that may need a little further color, then it points that out to you. But eventually the limited partners wanted to pivot to where they could take away the manual component. And that's about 9 to 12 months ago, where we then pivoted from an Excel sheet to building out a software, which is what it is now, to where limited partners literally drop in an investment summary PDF, and it answers like 80% of those same questions to point out.
Is all software basically AI driven at this point?
It's a huge AI component to it. But I mean, the build of the software, unfortunately, AI, the software. So we basically created our own AI agent. So the software building is still, we have two like 10x software engineers that they were one of the original sort of creators of DocuSign. So they can build this stuff out. So that part, you can't use AI. At least they weren't using AI. But the actual tool itself, we basically created an AI agent to where we use all the AI platforms, ChatGPT, Perplexity, all these other platforms, to where it actually decides based on its ability to answer a particular question correctly, which AI platform to use. So, for example, we integrate market metrics. So instead of going to census.gov and city data to find the crime rate and to find the population growth like we used to do in the Excel sheet, I'd give them the website, they'd go there, put in the zip code and find it themselves. Now the app finds all that within less than 30 seconds.
Did you ask the agent to potentially uncover better resources than what you're using? Because that's how this tool takes it to the next level, right? Because if it's like, well, you're using this city census, but so I would, it'd be interesting to challenge it also to find better resources for you as well.
Yeah, no, absolutely. Basically, it takes the zip code from the investment summary and searches out all the we don't go through it. We're not looking like CoStar and stuff like that. We go through the main 6 or 7 crime rates, school rating, population growth, employment diversity, all those key metrics that we all know that are the big foundational stuffs from the market perspective. Boom, it gets all that based on the zip code. You don't even have to type in the zip code. It gets it from the investment summary. So you can see, and then it color codes all those things just like the Excel sheet did. Is it red, yellow? Is the crime rate high?
You're saying it's pulling all the OM data and pulling it in.
Yeah. Yep. It just pulls it. It pulls it in, and then it uses any information in there, like for example with the market stuff, where it can go and find all that data for you, where you don't have to search it yourself and spend all that. So the beauty of it is that since these physicians who are coming home, you don't want to spend 2 hours on an investment summary deciding whether to invest in a deal. What's your hourly rate? Like, is it a couple hundred? Like, so you're saving yourself $300-400 of the hourly rate. If you can do that and truncate it down into like 5 minutes to get a quick read of a deal, as opposed to like fudging around in the investment summary. Where's the acquisition fee? Where's that? Where's this? Boom. It's all right there.
Sam, I want to share our passive investor framework that we created for Wheelbarrow Profits for passive investors. The first one is the sponsor, and we call it the jockey. The second one is the saddle, or the alignment of interests. And the third one is the horse, or the deal. So the very most important thing is the sponsor itself. You have to focus on that. And what I see most LPs or most passive investors do is they focus on the deal, which is the horse. And it's interesting because even when I started out, what's the rate of return? Where's the deal? Instead of saying, time out, I'm not running this deal. I need to find a sponsor. I need to find the jockey who's going to ride the deal. And then even more important than the deal is what's in it for me. Like, what are my interests? Are my interests aligned with the sponsor? Is he charging me too much? Is that my time hold going to be appropriate? Is it a good market for me? Is the risk good for me? What do you see with limited partners? What mistakes have they made? If a doctor's listening to this, or high income earners listening to this, and they're about to put money into a deal, what mistakes have you seen them make investing in that deal?
Yeah, that's a great question, Gino. And I agree with you 100%. Like our app has a component where it's called GP alignment, and it basically gives you a score based on and it looks at what's the waterfall, what's the acquisition fee, what's the split, is there a pref return, is there a catch up on the pref, all these different variables that goes into our GP alignment score. So I'm in 100% agreement with you on that. That's a huge variable. And
you're spoon feeding these guys, man.
That's what I'm here to make life easy. It's all about value proposition.
It's all about 2 clicks and 30 seconds, right?
What it's the reality is like you see so many people making money in this space that aren't adding any value. And to me, that's where we want to differentiate. Like, we start with the value proposition, and then making money will come later. But it's not like you look at this and it's hard to differentiate yourself, and that's our differentiation point. But to answer your question, Gino, I agree 100%. The sponsor is 1,000% the most important thing. The tricky part, and this is why I think people gravitate to these other deal metrics, is because it's somewhat objective, or at least interpreted to be objective. Whereas the sponsor, I mean, there is objective stuff, like how many full cycle deals do you have experience in this asset class? Where's the geography? Do you have in-house property management? Like, there's some components that's objective. But the biggest thing to me is doing what we're doing right now, like talking, seeing what's the thesis. Like, I like to ask some other questions, like what makes this deal different? Like, what's your competitive advantage in this particular market? Like, what makes this deal different? You can't get that from an investment summary. You can't put that into a deal analyzer, right? You have to have a conversation about that. Or if I ask for, give me 5 investors that I can call up and talk to them and see what their experience has been, I always start with calling the 5th one they give me. Now, could it be a family member? Could it be, but I don't want to call 1 and 2. I want to call 5. And believe it or not, some of those people, when you get down to the nitty gritty, they're like, is this off the record? And they'll tell you something that you're like, this is a guy that is supposed to be giving them, or a guy or girl that's supposed to be giving them a good recommendation, but they're getting down to the honest part of it. So you can't put that in a deal analyzer. So we realize that there's still, value in doing exactly what we're doing, especially when you're first getting to know a sponsor. Like, if I've done 3 deals with you and I'm happy with what you guys are doing, the communication, the whole thing, like, I know that I need to do that again unless it's a unique deal opportunity. But this is the most important thing. But for the other stuff, that's a pain in the butt to get, or you don't see it in the investment summary, and then you got to go back to the sponsor and say, well, what's this? I didn't see it in here. We have an Ask the Sponsor feature through the app where you literally click a button and it curates all the questions that you can't answer and sends one email to the sponsor to get them to answer those questions. So you
love that. Share those questions. Can you share a couple of questions for me that people should be asking this? So if you're listening to this, you're a doctor, you're a lawyer, take notes right now, because this is really important, because these questions can save you a ton of money.
Yeah, no, 100%. Now, the biggest, I think, other than talking with the sponsor, getting into some of the nitty gritty with the sponsor, because as a limited partner, like, we hear this all the time, but it's easier said than done. You want to diversify across sponsors, across asset classes, across geography, across debt structures. Like, there's all different variables that you really want to sort of diversify. But if it's a 50,000 minimum, like, you can't do that instantly unless you like join into a fund or something like that. So it's going to take time to get to that diversification point. But in terms of the biggest movers in deals, I feel like, as you mentioned before, the debt structure years ago, like from 2011 to 2008, 17, 18, like, you could do fixed rate debt and have really good deals and get really good returns. But once we started hitting like 17, 18, to get some of those deals to pencil, it made more sense to do some of the variable debt. And so you saw a lot of these deals doing that. And listen, there's ways to insulate it if you have some rate caps. But even with the rate caps, when they reset, we see like now nobody expected the interest rates. They hit everyone in the face when they changed so as much as they did. But then nobody expected them to stick this long. Like, it was survive till 25, and now we're in 25, and who knows when we're surviving until.
There's another little slogan, because there's this one restaurant that all the bankers go to for lunch, and I go in, I listen, and there's a new one. I forget what it is. I got to write it down. But dude, I was literally walk out of this place and hear that minimum like 2 times while I was in the restaurant. And it's like, oh, just survive until 25. I'm like, okay, like
I know. So you just can't predict it. But I mean, all of us, sponsors and limited partners, are going to look at variable rate debt differently. Now, one could argue
we've never touched it.
Yeah, someone who's unbiased, like maybe right now is a better variable rate opportunity, but to try to find limited partners that are going to invest in a variable rate deal, unless you really have sort of good perspective, it's going to be hard to do. So that's changed.
There's too much risk there for my tolerance. Like, I just want to be able to sleep at night, and that's why we've never touched it. And we found like our workaround to it has been like 5-year fixed. with a credit union and a loan to cost deal. So you're getting your renovation money put in. The fee structure is way lower. It's not even close. I mean, it's like nothing. And then you're fixed for 5, and it may not be as competitive as a rate, but that's okay because you know that you can handle the debt load today. And it should, and if you're not executing your business plan, only get better as time goes because you're improving the operations. So the challenge obviously is the recourse component, and we don't do syndications, but for a raise, there can be issues there, and that's what sort of blows it up. But for folks that are not syndicating it works quite well, at least in our experience.
Jake, that's admirable that you guys are doing that, and I agree. I think the fix that's. I mean, you and I know.
Literally, I've never done a floating rate deal ever.
That's amazing,
and we have 40 some communities, right?
When everyone else was doing it around you, it was
but that's why I went back to what you were saying
that's hard
about
to do with that when people are doing that.
You have discipline, and so what you were saying is you had your buying criteria, in your deal analyzer, right? And you had these flags. The reason that we have weathered the last few years so well is we like to buy, say, 300-400 units a year, right? 2020, I think we did 80 some units. 2021, we probably did 100 units. 2022, we spiked a little bit there towards the end of 22 when shit started falling apart for people, right? But it sucked. We were like clawing for some sort of value and like, we're never going to buy a good deal again. So we had 2 low volume acquisition years, but then it's popped back up. We're doing 300-400 units a year again now. And it's like, great. We weathered that. Yeah.
That speaks to you guys, and I applaud you for that because I'm seeing people.
I'm just scared of it.
Yeah, that's totally true. And you see people now, and I'm not naming names, that are popping out deals, still syndication deals every week. And I'm like, do you guys know what the environment is out there? Like that in and of itself. Like I see some people on the sidelines, and they you want to make money. You got to make money. You got to keep the lights on. But they're not pumping out deals because the reality is there's not a lot of good deals out there. So when I see
a lot of the deals, I want to elaborate on that just for a second. Not a lot of good deals out there. You're seeing a little bit more now, but what I interpret that is you're seeing a lot of dog shit hit the market. C-class, 60s, 70s, right? That people have got floating rate debt on, and they can't sell it for the life of them, right? And that's what I'm saying. Like you're not seeing a lot of the quality built stuff on the market right now because it's not a good time to be a seller, right?
Yeah, no, you're 100% right. I mean, and the other thing is some of these deals. So when I see sponsors popping out deals once every week, like to me that's like, what's going on? Like that's tough to do, but in this market. But the other thing is you see some of these deals, and listen, it might be appropriate, but a lot of them have a lower exit cap than an entry cap. Could that be right? It probably is right to project that, but if you can make the deal work without it's typically the 0.1, bips per year. So you go 0.5 up for a 5-year hold.
What are you seeing? Like, what are you seeing entry and exit?
Yeah. I mean, it depends on the market, but sometimes I'm seeing like 0.5 less on the exit. So if it's a 5.5 cap, I'm seeing a 5 cap on exit. So,
see, I don't want to see that right now in this environment. I want to see 6 to 6.5, and if you're exiting at 6, like so you're 6.5, exiting at 6, 6.25, and you're at 5.75, and that's all going to be rate driven, right? If rates go back down, if you're getting 4% debt, they may have an argument, but I want to see their crystal ball and why they know that the rates are going to go down to 4. I hope they do. It will help me. But I can't predict that for certainty. If they can make the
deal pencil without that projection,
you feel a lot better about it.
And then you're getting leverage that's high. The debt is higher than the cap and going in cap rate. Like you got a negative.
This is another thing that makes me an old stodgy prick. We really primarily look at cash on cash return. Okay. And it's, I asked one of the AIs the other day, what is the single most important metric as a multifamily investor? And you know what the answer was?
I'm guessing cash on cash came up with
essentially that. It was cash flow.
Yeah.
Right. But so we try to get so fucking cute with this stuff and the metrics and this and that. But at the end of the day, if you're net positive from a cash perspective, it's going to save your ass. And the best thing that we've ever done is we've always been, in our analysis of our deals internally, very cash centric. Like we our biggest metric is profit per unit, PPU, which is essentially cash on cash or cash flow, what the money that's left over at the end of the month. And we manage the cash very tightly. It's not that we're not looking at our, in our portfolio and our NOI and what, looking at cap rates as we go and things. We look at that, all that stuff, but very driven by the cash. And that's what's going to keep you in business and keep the lights on.
You're 100% right. And it gives you flexibility. Like if you have to pivot, like say there is an economic change or a market change or a political change, whatever it is, it gives you the flexibility to pivot. It's just the same in someone's own personal life. Like if you have some free cash or you have the ability to kind of do things, if things change, then it gives you some flexibility. And I think and we sort of just to sort of underline what you were saying, Jake, what the second sort of tab other than GP alignment is our IRR partition tab. So we look at what's the projections based on the sale versus the cash on cash. So a deal that has over, we want to see like over 25%, 23 to 25% of that projection to be the cash on cash and not the sale component of it. So when you get these in the investment summaries, the projections based on 100,000 investment, like that plugs into the IRR partition, and that's the other risk profile, because if that cash on cash is higher, it just gives you flexibility. Like if I got to refi, whatever I got to do, that's probably, to me, that the cash on cash going in and the debt structure are huge variables that I think even if you just look at those two things, you can get a lot of information on the deal.
Well, because the debt structure creates your biggest risk, especially if you have something that's floating, right? And so you're looking at that, and that's why I just never wanted to touch the variable rate stuff.
So what's the 5-rate fixed stuff do on the prepay? So the argument always against these fixed is that you got to prepay or
no prepayment penalty,
no prepay on it. So it gives you flexibility if you want to exit. Your
origination fee with a lot of these credit unions is like literally like $1,800. They'll charge it's like some sort of fee or something. I don't even know what the hell they call it. And then because it's a credit union, I don't know. We just got to check, Gino, for like what, 25 G's because we're a member. We didn't even know it was coming. I go, dude, we just got to check for 25 grand because and then the craziest thing is, so you don't have a prepayment with them. And they'll do loan to cost. So you do 80% loan to cost. So you get your renovation funds baked in. You just got to be okay with having a recourse deal. And if you believe in the deal and you believe in the market, right? Like, I don't know. It's worked.
Nothing's for free.
Us.
There's got to be a cost. I think it sounds like a decent cost benefit ratio, what you're describing.
But it's challenging in the syndication space, though, because you got to get folks comfortable with that. And people, rightfully so, don't want to deal with that. Gino, I got like 4 questions here. Do you want to? Do you have more, or do you want me to kind of get into this?
No, let's take a quick time out to hear from our sponsors. This episode of the Jake and Gino Podcast is brought to you by Wheelbarrow Profits, the premier multifamily education community. Wheelbarrow Profits proof is in their results. Their members have closed over 86,000 units. That's over $5 billion in student deal volume. Are you serious about taking your real estate game to the next level? Do you have the confidence to take action? Schedule a call with the Wheelbarrow Profits team today and supercharge your real estate knowledge. Build lasting relationships through unparalleled networking opportunities. Obtain lasting knowledge on how to buy multifamily real estate with intensive training. Gain hands-on experience through their live events with like-minded individuals and industry professionals, all while experiencing the personal touch and family atmosphere that set them apart. Visit wheelbarrowprofits.com for more information.
All right, we are back to our leaky gut special here. I'm just gonna jump around a little bit, so bear with me. All right, the passive you're with passiveadvantage.com and you have the LP deal analyzer. That's sort of the space right now. Do you want to elaborate on either of those before I start asking more about leaky gut?
Yeah, so I mean, we haven't raised any capital to date, and we don't plan to raise any capital.
You have a community. You have an online community essentially, and
we have an
products
online
for folks.
Community where we're trying. So I polled that group of 700 physicians at my hospital. How many have heard of syndications? Of the 700, it was 10. I polled that group, how many have invested in syndications, how many have done it? It was 2, including me. So it's a huge, the physician community is a huge untapped space. Now I'm blessed to, over the last 6 months, have the ability to cut down to 4-day-a-week job. And all these passive investments, even though, some of them are paused, but there are some that are still giving me the cash flow that I could cut back. So I want other people to be able to do that. So to get back to your question, Jake, I want to make this space more approachable. And I feel like right now there's a lot of people a lot of limited partners on the sidelines because, fairly enough, they've been hurt. I mean, there's bridge debt, there's capital calls, all these other things. So we feel like there needs to be a bridge called transparency between the sponsors and the limited partners to bring this space back to where it needs to be going forward. So we're hoping not to get too out, like goofy, but we're hoping that this sort of transparency on the sponsor side allows limited partners to get back. So the goal is to form a marketplace where sponsors place deals that are already pre-populated with so instead of the limited partners doing the check stuff, the sponsors will be the one, when they place the deal, they'll be able to use the app the same way, but they'll be the ones cross-checking. So by the time the limited partner sees that deal in the marketplace, it's all done. They don't even have to do it anymore. So now
there's high value in that because you get an OM or you get something from a sponsor, and they're all different. The blah blah blah. It's challenging to sift through it. So you're basically creating a predictable, easy way for folks to digest this stuff that will be the same every time they see it, and it's actually going to be good too because
so you get familiar with that. So that's the goal, Jake. Is to do it that way, to where it's not like there's no ulterior motives. We're not raising capital. We're not getting GP shares. We're just trying to provide value to the limited partners to bring to make it this whole space more approachable for them, especially at a time when they're on the sidelines. But we're also trying to bring value to the sponsors in that if they're willing to give us some of the deal details, and now we've already grown to like 4,000 investors since we launched the app like a month ago from 1,500. So now you're coming up into the marketplace and you got access to 4,000 limited partners, and I'm not charging you for that. So we want to bring value to both sides to where it's like a no-brainer for both sides to kind of come together on.
The reason I like that is because I think I don't know what the percentage, 9 times out of 10, it's going to protect the investor so much more than the way they're investing now. And I think the way most are investing now is they're listening to something like this and they're like, oh, that Gino, he seems like he's such a nice man. They want to pinch his cheek, and then they throw and give him 100 G's because he's a nice guy and he's approachable, right? That's how most of these people are investing now. This is an objective, it sounds like a data-driven approach to insulate folks, which is needed right now. Because I think that a lot of folks got burned because, they feel like that Gino was a sweetie. And I'm not saying, like, Gino is a sweetie, but like that's probably not how you should be making, your investments. Right?
Gino is a sweetie, but you're 100% right in that.
Yeah, we got a little smile out of him.
So it definitely protects the LP in that it gives them like our goal is 2 components. One, to ease the time, make it easier, make this whole space more approachable, and then to point out risk profiles, but also to educate. Like we host webinars monthly. So if someone's like, I don't understand why this is important or why this metric is important. So the tool itself, because it's obvious which are the metrics we're looking at, like it's in and of itself an education tool. So for those people, as you continue to use it, you're like, all right, now, yeah, I see and these metrics become just like they are to us, like they become like second nature. But the other thing, like you said, it does protect the sponsors, because you have some sponsors and then just some capital raisers that.
Well, they need to bring accurate data to the table. That's the one thing that makes you like, if they're bringing, dishonest information, that's when this falls apart. But you're not going to be in the game long as a sponsor if you try to do that.
If you're doing that, and then they get kicked out of the platform. But you're right in that there was a false expectation or a false comfort with limited partners, with sponsors, based on what you just said. Like, I like Gino. He's a great guy.
He's got a platform. He drives a Ferrari.
Yeah, and then next thing you know,
yeah.
6 months ago, he's asking me for a capital call. And now he's like a douche, and I don't want to talk to him.
Well, because the brakes on the Ferrari are expensive, man.
Exactly. But if you show these metrics ahead of time and you realize that there's risks, it's the expectation is like, well, it is what it is. They did what they did. I chose to invest in the deal with my eyes open. It wasn't like I'm just trusting this guy. So in a way, it protects the sponsors from that mentality. Like, you look at some of these crowdfunding platforms that are getting bad raps. Like, that's the issue, is there's a perception of sort of culpability when in reality, it's on you as the investor. Like, I'll be the first one to say that. But these kind of things, when you're looking at all these metrics, it makes it more obvious, as opposed to just being like, I like the sponsor and I'm going to invest with him. And now he's asking for more money and I never want to invest in him again. It's a more open, transparent communication process through the whole investment.
I'm so glad that you said that. It's because LPs need to take some type of responsibility for the mistakes that they made, because I was on that side as well. I invested with the gentleman. I didn't know underwriting. I didn't know the market. My interest didn't align. And ultimately, I was pissed for a couple of years. But then I came to the realization, no one put a gun to my head. No one told me to invest. I didn't know what I was doing. And I think it's a little bit of tough love for anybody listening to this. But if you're in that situation, use it as a learning tool. It's a problem right now, but it may be an opportunity to say, yeah, this is one of the best vehicles that you can invest in to create wealth. I just didn't drive the vehicle very well. I didn't know how to drive it. How do I learn how to drive it? And I think your platform and the education that you have will help people learn how to drive the vehicle, because ultimately, long term, you want to get out of the stock market. I'm sorry for saying this, everybody. You want to get out of the stock market. You want to get out of the Ponzi scheme. You want to be able to control your own destiny. And by having a vehicle that is a basic human need, that has amazing tax benefits, that does give you cash flow, that is something that's going to be around forever. You can't buy it on the internet yet. It's something that's really great. I think everyone needs a way to participate in it. And I think if you understand that as an LP, you do make mistakes. You can blame the GP. There have been a lot of bad sponsors out there, a lot of bad information, but ultimately it comes upon you that you have to do your homework, and you have to say, if I made a mistake, it is partly my fault.
You're 100% right. I agree. And I tell LPs when we have a conversation, like I talk to them all the time, and they're saying that about this sponsor, that sponsor, like, man, you got to take some responsibility. And if you went into it and you didn't do any of this sort of listen, I'm not saying everyone's got to be as analytical as I am about it, but that's why we're trying to make it approachable. So for even people like Jake, who or people like, that don't want to get, I'm kidding, Jake, by the way. I know you're very analytical.
No, you're not. It's 2 clicks, baby. That's what I'm saying. So,
but for people who say, you know what, just tell me what to invest in. And we've all heard these investors that just are like, tell me what to invest in. I'll give you my money. I just don't think that's the right approach. And I try to say to physicians, like, how long did it take you to earn that 50 grand post-tax? Like, if that's 100 grand of income, is that 3 months, 4 months, whatever it is?
And how many years did you go to college? How long did you guys go to school to learn? I mean, you took a year to learn multifamily. You went to school for 15 years to become a doctor. I mean, give me a break. Think of it from that perspective.
Yeah, all your money is cut in half until like you're 20, right? It's like
exactly. That's exactly right. So we just want people to go into these investments with open eyes. Like, I'm looking forward to the next couple of years to get these great investment opportunities. So I want, when the time comes and we're starting to see things turn now, like, I want people to be ready, to be comfortable with the usage of my app or whatever the tools they want to use to help them, so that when the time comes that these investments are coming along, we're not sitting on the sidelines and before you know it, we're like, oh man, I wish I would invest a couple years ago, 5 years from now. So now
think of yourself as the GM
right.
of your money, right? You are the general manager of your money. And if you were, on the Yankees and you're the GM and you're going out looking for players, that's essentially what you're doing here when you're shopping these sponsors. You're going to be giving them money for their performance. The difference is, you're going to get somebody, you're the Yankees GM and they're 30 years old. And what the Yankees used to do is they take the 30-year-old guy, give him a guaranteed 10-year contract, and he'd get 2 or 3 good years out of him. The cool thing is that with these sponsors, the track record matters. So if they have 10, 20 years in the business and they've had a high performance, right? You don't got to worry about them blowing their knee out in 2 or 3 years. That's actually a good thing to look for. So I think one thing that people, and again, I'm going back to the same statement, look for track record, look at years, doing the thing, and then what their returns were like. And not so much that they're a sweetie on the podcast, right? So I'm like crucifying ourselves here. Okay, I'm going to get into some other things here, but it sounded like you have about an 8-year. Actually, I'm gonna go here first. Solely an LP yourself? Are you a GP as well?
Solely an LP.
Okay, so what is it that are you looking for the dividend? Are you looking for like those Verizon type investments where you're actually going to get cash every month versus just having the price go up? Is that the desire? What's the thing driving the LP investments?
Yeah, for me, it's both. Like I like having some that are safer and that just give me the steady stuff. Like I invest in some triple net investments, some industrial deals that it's more like a steady income type of stream. And then I invest in other deals that have a little distress. I have one or two development deals that I'm investing in. So it's all about that diversity, like having some of that diversity. And if one of these deals pops, that's a higher risk, and that's fine. But I realized going in, just like we were talking about, like that's a higher risk deal. So I have a chance that I can lose all my money in that deal. And then I have some of these other deals that serve as the foundation that I feel like are less risky, maybe less return, but it's stabilizing my overall portfolio. So over time, I try to bring all those in so that it gives me a little bit of diversity to where in the end, when you look at the overall return and the overall risk, I'm comfortable with where it is with that. And then you could adjust on the fly. Like as I get older, like maybe I'll have more of that safe stuff and a little less of that risk stuff, or maybe I won't. So it's all about like what your risk profile is and then being comfortable with that, and then trying to get a portfolio of these syndication investments that represent that.
Any chance in the future that you're like, man, I'm sick of treating leaky gut and I'm going to just step out and either be a GP or I'm just going to buy deals for myself and run them?
Yeah, no chance, man. The thing is, I love.
But that's why this is great. That's why the syndication space is great. You can participate and continue to do what you like.
Yeah, I love what I do as a GI doc, to be honest with you. Even if I tell people I work with all the time, and not to sound too foofy about it, but even if I won the lottery, I would still work.
You gotta do something, right?
Do GI. Well, because I really feel like I'm making a difference, and for me, like that's my calling. Like I love the real estate stuff, but being a doc is my calling. And maybe not everyone feels that, but I've been blessed to be able to feel that way. And it really does mean a lot to me to kind of like help people that way. The other component is that when I'm talking with you guys or talking with other investors, it's a different conversation if I'm still a practicing physician on the front lines, like when we went through COVID and all the different, the different sort of crises and just things that physicians deal with on a daily basis. Like if I'm out of the game, and not to talk bad about any other physicians that have now transitioned to just doing syndications or real estate, they've kind of turned the flip, but it's a different conversation that I could have because I'm still doing that every day versus somebody else. So on the secondary component is I feel for me to relate to my audience, and of those 4,000 investors, like probably 70 or 80% are physicians or dentists or, professionals in that way. I feel like I want to be in the space, and I don't want to tell them like, yeah, I shifted out, because to me, that's not the goal. The goal is if I'm coming home at night from a hard day at work and I get an investment summary and it takes me 2 hours and then I'm taken away from some family time, or I can't put my kids to sleep while my wife's doing it, I want to be able to spend 5 minutes and then I'll be the one to put them to sleep, or I'd be the one to take them to dinner or do like a date night with my daughter or something like that. Like the flexibility where I can choose to kind of do that. That's really what the goal is for me, as opposed to like getting out of it.
Well, it's very relatable for your audience, and you're sharing those commonalities, so it's cool. Yeah. Okay. So last question, I think here. I know I got a couple more, so I'll go quick. Just curious. Sounds like you started roughly 8 years ago. How has your view and opinions evolved? Because I'm sure you had these assumptions when you got in, and that you're the GM of your family money. You're looking to grow and provide the best life for yourself, your wife, and your kids, and everything. And you had these assumptions as you got into it, but I'm sure they've shifted and evolved. What are like some of the top things that have changed?
in relation to personal finance as a whole, or the syndication?
Maybe like the syndications and the real estate. Like as you were like, because you're like, I want to get a duplex, and then I went into syndications, and I thought it was going to be this, and then because it's like the perception versus reality. I'm just curious if anything stuck out that this is how I thought it was going to be, and now it's this, but I still like it, right?
Yeah, I mean, so in full disclosure, like I did invest in some of those deals with bridge debt. Thankfully,
And you're still here. You're still here to talk about it, right?
exactly. I mean, I'm invested. I'm as an LP. I think probably close to 30 deals, and only 3 or 4 had bridge debt. So thankfully, and 2 of them are still producing, and they're good. They're doing fine. And then one is paused, and one I had a capital call. So I'll be the first. But to me,
out of 30 investments, you're doing pretty good.
they're not all multifamily, but no, I appreciate it. Probably 60% of those
Must be that LP deal analyzer working for you.
Well, I'd like to think maybe there's some components of that, but I mean, I know some limited partners, guys, you wouldn't believe, where like they did like 5 deals, and all of them are capital calls. And it's like, and some of these people, it's just, this is their introduction to the space. And they're like, screw that. I'm staying in the stock market.
No, you get hit in the face with a textbook.
Exactly. So I think that's evolved, and that, obviously I'd be more cognizant of some of the risk factors, but I think, I'd like to think I went into it with eyes open, and that I know this is not a savings bond. Like there's risk involved in these investments, so I want to see sort of the risk benefit ratio, align. Like if I'm going to do a development deal and it's got the same IRR projection as a Class A multifamily, like why am I going to do that? Like there's no risk premium. It's like a couple years ago, when people were Class A and Class C, the risk premium was like this. It's like, why am I going to invest in a Class C deal when I can get a B plus for a similar cap rate? So as an investor, you need to kind of know what the risk premium is. And I think the secondary sort of thing that has evolved is I'm more cognizant of that, even more so than I was a few years ago.
We'll buy a C, 1970s deal, but it's not going to be anywhere near close to cap rate that we're paying for a B or an A. So
yeah, and that's what you got to do.
You got to do it. Yeah, no, because there's challenges there. If you have to replace all the plumbing, you better be, and you hope you have 15 years on it or something, right? But there needs to be some sort of reason why you're okay taking that on. All right, so you were talking about like maxing out the 401k and then maxing out the 529. Now, the sweetie over there, Gino, right? He's got a different take on it. He believes in buying assets to pay for the event. You know what? I'm not even going to steal his thunder. Gino, tell us about buying. You know what? Tell us about Courtyard and how that's paid for college versus a 529. And we're gonna pull your audience over to a different perspective now if the sweetie's willing to go there.
Well, it's actually interesting. I had an epiphany when I read Killing Sacred Cows by Garrett Gunderson. And he made a simple point. Do you want to be in business with an entity that has no regard for financial intelligence, which is the US government? I'm going to put money into a plan with them when they can change the rules whenever they want. So I just felt awkward at that point when I had my money in the stock market. And I'm like, okay, they're creating demand for the asset in the stock market by having you put money in a 401k, and they're creating the supply. So when you turn 70 and a half, they're making you sell it. So you have control, and the fees are crazy. The lost opportunity cost is annoying to me. So for me, back in 2013, when I partnered with Jake, I learned that instead of saving for an event such as college or for retirement or for a vacation, I want to save to buy an asset. That asset would pay for the event. When the event was over, lo and behold, I still own the asset that was producing cash flow. Whereas if you put more money into a 529 plan, if your child goes to college, when your child goes to college, that money is gone. Whereas my little property that I bought back in 2013 for $600,000 is now worth over $3 million. It's producing between $8,000 and $10,000 a month in cash flow, of which I get a third of that, which is around $3,000 a month. I've put 2 of my children through college, and I've still got that asset producing tax benefits, producing cash flow. And from that one single asset, it's created an amazing amount of wealth. Whereas we're taught to save, and saving is the most important component to beginning the financial foundation, that foundation that you need. But from that perspective, if you really want to level up your game, you need to start buying assets that will produce the money that you need for the event. And once that event is over, you still own that asset. And if you can buy one asset for this event, one asset for that event, all of a sudden you'll start creating wealth. And I think that's the difference between the middle class mindset and the wealthy mindset.
No, you're 100% right, Gino. I agree. I think that's the preferred sort of way to do it. I think the sort of the sort of jump you have to do is you got to make sure you're buying a good asset, you're confident it's going to cash flow and sort of get to that point. But there's no doubt that's the better way to do it. Like I had my wife's cousin, they live in Boston. They own like a beach house. They did a short-term rental in Cape Cod. And this girl always wanted to get married at like Rosewood or one of those places in Newport, Rhode Island, where like Gatsby was filmed. That was her dream. But those weddings are like crazy. I mean, weddings are crazy now anyway, but it was like, I don't even know.
Average wedding, I think, is like 35 G's right now.
So they basically had that short-term rental in Cape Cod. And instead of using it for 2 years leading up to it, they just rented it out, saved up that money, paid for this, fairy tale wedding that she wanted, and then they still have the asset. So that's a perfect example of what you're saying and where they utilize. Now the wedding's done, they could then use it more, rent it less, and sort of go from there. But yeah, no, if you could do that, that's the preferred way. I just think the barrier for entry or the intimidation of figuring out what asset that is what you guys can help people bring it down.
This is the challenge for Sam today. We're just going to ask you to do one. You're going to do one. All right.
It's not leaking gut related, is it, or no?
No.
Okay. All right. Good. Then I think I have a
find one multifamily. Doesn't have to be the biggest. Find one multifamily in your lifetime, sooner than later. Buy it yourself. This is the Sam challenge today. Don't have to do any more. Just do one. Get a great management group to work with. Okay. Do one yourself, and then call us in a few years. That's all I'm asking. Could go well, could go bad. I'm not guaranteeing anything, okay? I'm just saying, just dip the toe in. Put an LLC out there maybe, see what happens. This is a challenge, the Sam challenge. See what happens, and then 5-10 years from now go, man, you guys full of
right.
shit. Or holy crap, I just paid for 3 kids to go to college. No guarantee of anything here. I'm just saying, you've been successful with it. Give it a shot. See what happens.
I appreciate
just do one. You don't got to do any more.
No, I think it's a reasonable request, and I take it seriously. I'll get back to you with it.
Buy and hold for cash flow.
Yeah.
That's what it's got to be. It's got to be a buy and hold. We're not going to flip it. We're going to buy it for cash on cash, and we're just going to sit there and see what it does over 20 years.
I love it. I'll do it, Jake.
All right. I'm very excited to get this case study in 20 years from now. Gino, the sweetie, take us home.
Sam Giordano, the self-proclaimed belly/butt doctor. You heard it? New Jersey product. Got his wife from California to live in New Jersey. That was a miracle in and of itself. And the miracle is that he's still living in New Jersey. But I think in the next decade or so, he may become a Floridian resident like myself. But you never know. I'm not holding you to that, but it's
a lot of leaky gut in Florida. I heard. Go where the business is.
It's all over.
As I said, that's actually an interesting point. In 2017, he goes out and he starts listening to the Jake and Gino channel and the podcast. And I'd like to say that we converted him over to multifamily. But I think once he had his whole financial foundation set, he's like, okay, I've got this maxed out. I've got that maxed out. What's the next step? And I think that's the next iteration. And for any doctor listening onto this, the app sounds amazing. And not only that, you'll have the accountability. You'll be able to look at, deals. You'll be able to get part of the community. You'll be on those webinars. And for any doctor, for any high-income earner that wants to start getting into the business, is it passiveadvantage.com?
That's correct. Yep. Passiveadvantage.com.
Yeah. So go to passiveadvantage.com. And for those of you out there, once again, I'm going to end this like this, Jake. Very simple. You've been a physician your whole entire life. You've been grinding away for years and years and years. Give yourself some compassion to learn how to actually take all the knowledge that you have and all the experience that you have and transfer the money that you're making now. So learn how to create wealth through that. And you don't have to do it by yourself. You don't have to know everything. You just have to know the right people, and you have to trust the right tools to be able to start creating wealth today.
Well said, Gino.
100% right. I love that.
You sweetie. All right. Gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He is the G Daddy. We make it happen. We'll see you next time.
Thanks, Sam.
Thanks, Sam.
Thank you, guys. Appreciate it.